So for those that don't know me, my name is Connor McMahon. I'm one of the broker advisors over at Sterling Commercial Real Estate, and I'm going to talk about retail today. So in order to kind of frame where we are at for retail, to kind of understand the retail market today, I want to kind of back out a little bit and kind of tell the story about kind of how we got here. And much of that story over the last few years has kind of been a story of doom and gloom that has not come true. So when I first got started in the business, it was 2016, the big buzzword then was the Amazon effect. And all we heard was how retail was dead and that this Amazon effect was going to change everything. And that brick and mortar as we knew it was pretty much going to go away. And it was a really scary thing for a lot of retailers. Well, then what happened? Of course, Amazon moves into brick and mortar, and they understand the value of old-fashioned traditional retail. So luckily that fear didn't really turn out to be true, and our retailers were really smart, and they understood how to adopt, internet, online shopping, and kind of the more hybrid retail that we see today. So what was the next really big scary thing in retail? Well, 2018, all we heard was about how malls were dead. Nobody was ever going to go into a mall again. They were going to be empty and obsolete, and there's going to be big vacant empty boxes all across the country. Well, what ended up happening? For the most part, the malls were really, really smart and were well funded, and they redeveloped and redesigned the malls into really functional, effective retail environments. And the retailers that occupy those mall spaces do very, very well, and they report really great sales. As can be seen here, this mall REIT is hard to ignore because of its fat dividend yield. Who doesn't love a fat dividend yield? So our malls are doing well, generally speaking. And then, of course, what was the next big scary thing? COVID, of course. All we heard about was the new normal and how nobody was going to go back into a store and social distancing. And that was kind of it for retail because people were just not ever going to go back and shop in person. Well, of course, that didn't happen. As we emerged from the pandemic, 2022, retail was doing incredible. Our retailers and stores reporting record sales. And that leads us into 2023, where every day is game day. So retail is a really resilient asset class. It's gone through some really big challenges. It's continued to adapt and evolve to adjust to those challenges. And even though 2023 is looking like a very highly positive year and our retailers are optimistic, we're certainly not out of the woods yet. So what are those potential next scary things that we could be facing? Here's just another slide showing the biggest gains in 2 years. So some of the things that retailers could be facing over the next year, obviously inflation affects everyone. Supply chain challenges still continue to exist. They're much improved, but retailers still face challenges there. Employment continues to be a very large challenge for a lot of these employers. So it could be any one of those three things. It could be a combination. It could be something totally different. But where we're standing right now, from what we can see from the data today, it paints a really, really good picture. So we have vacancy has gone down. Lease rates have increased significantly. Sale transactions are up, and average and median sale prices are up significantly, and the sale price per square foot is up significantly. Now, if you attended MarketWatch last year, you might have, remember the little caveat about 2021 retail. We had a lot of really, really old product, tired product that had been on the market for a very long time, that leased and sold, and that caused some of those lease rates and sale rates to soften a little bit. So even though we saw these huge jumps in 2022, some of that was due to the market, some of it was just that it was newer, fresher, not as obsolete product that we saw. So when we're looking at this, we can see, your typical supply and demand factors are at play, and it paints a really good option. So in general, everything is awesome. And if anybody does not get the reference to this, all the parents will get it. This is the Lego movie. If you haven't seen it, highly recommend it. It's fantastic. So thinking ahead about, all right, what are some of the challenges that we might be facing here? I want to bring up some interesting examples here. So I pulled up some listings. It didn't take a whole lot of research to pull. There's dozens, if not hundreds, of these single tenant net lease listings right now on the market. And in retail, single tenant net lease, that's kind of like the gold standard. Everybody loves it, everybody wants it. People always say, hey, treat it like a bond, it's super safe, it's never gonna fail. So here we have 3.73 cap rate, 3.70 cap, El Pollo Loco for 4 cap, 3.85 cap, 3.25 cap. And I did cherry pick the data here a little bit, but there's plenty. If you want to buy a 4 cap property, there's no shortage of options out there for you. Well, the same day I pulled these listings, this is what the 10-year treasury was at. And I checked today, and we just popped over 4% again today. So it has gone up. So, well, what are you going to do? Are you going to buy a real estate asset that's supposed to behave like a bond at a 3.2 cap, or are you just going to actually buy the bond? If you really want to buy the Chick-fil-A, I'm not going to stop you, but if you're looking at how best to use your money, well, obviously there's some significant challenges here. In the same day, here is a list of buyer requirements. These are listings. And I don't know if you can see it here, but every single one is minimum 6 cap, minimum 7 cap, 6 cap, 6 cap, 7 cap. So we can see this really, really big divide between what the buyer expectations are right now and what the seller expectations are right now. And obviously that gap is never going to be totally closed. There's always going to be some little difference there. But we're not going to negotiate a 3.2, 3.5 cap property up to a 7 cap. It's not going to happen. And I don't pull these up to say that one group of people is wrong or that the buyers are idiots or the sellers are idiots. That's not the case at all. The people in this category here, they're just dictated by the cost of money. It's simply what they can afford. Where the folks here, they probably underwrote these exit cap expectations 2 years ago when the market was very different, when the cost of money was significantly less. So this is just a challenge. It's just going to take time for the market to heal a little bit and for these expectations to come together. Because right now we're seeing a lot of stalemate in the market. So what do? We still have to be able to operate in this market, in this environment. We can't just put pencils down and back away and say, we'll come back when it's a little bit easier. So if you're a buyer, what do you do? If you're an investor, how do you operate in this environment? Well, you can do a couple things. First off, spec retail is really, really promising right now, especially in Missoula. As we've seen, the pipeline is very, very low, our vacancy is low, and our lease rates are up. So if you are interested in spec development, seek out growth areas, places like the Y, places like Midtown that have a lot of opportunity. And even with higher interest rates, we should still be able to achieve positive leverage in these sort of investments, because the lease rates have came up to the point where that's very much still doable. A year or two ago, Claire gave an example of negative leverage. That's too much math in public for me, so I will not be doing that. But even still, with higher interest rates, it should still certainly be achievable. So if you're a seller, well, what do? Inventory is low, which is good, but you're still going to have to manage that buyer expectation, which is going to be challenging. One way that you can get around that is to be creative. A lot of folks are now talking about seller financing. 2 years ago, when the cost of money was so cheap, it wasn't really a conversation, but now it has come up as a really attractive option. So that might be one way to get the your required exit cap or the yield that you need. And if you are an operator, if you're a retailer and you just need to expand and look for a new space, it's really tough right now. So a lot of it is just being prepared, being teed up, be ready to move fast. The market is competitive, so when those opportunities do come up, you just have to make sure you're in a position to move very quickly.